One Up on Wall Street by Peter Lynch is a classic investment book that focuses on the following key points. 1. The importance of investing in what you know. Lynch stresses the importance of doing your own research and investing in companies and industries that you understand. 2. The value of patience. Lynch believes that successful investing requires patience and a long-term perspective. 3. The power of compounding. Lynch emphasizes the importance of reinvesting dividends and holding on to your investments for the long term. 4. The benefits of growth investing. Lynch argues that investing in growing companies can lead to high returns over time. 5. The importance of diversification. Lynch stresses the importance of diversifying your portfolio across a variety of industries and sectors to minimize risk. These are some of the key takeaways from One Up on Wall Street, and the book is widely regarded as a must-read for anyone interested in investing in personal finance. The power of compounding. The power of compounding refers to the phenomenon by which an investment generates earning on both the initial investment and on the accumulated interest and returns over time. Compounding occurs when the returns on an investment are reinvested, so that the returns earned in one period are used to generate additional returns in the future. The longer the investment is held and the more frequently the returns are reinvested, the more pronounced the power of compounding becomes. The power of compounding is a key principle of investing, and it highlights the importance of starting to invest early and holding on to investments for the long term. By taking advantage of the power of compounding, investors can potentially generate significant returns over time, even with relatively modest initial investments. Growth investing. Growth investing is an investment strategy that focuses on buying stock in companies that are expected to grow at a faster rate than the overall market. The benefits of growth investing can include 1. Higher potential returns. Growth stocks often have higher potential for price appreciation, as their earnings and revenue are expected to grow at a faster rate. 2. Long-term focus. Growth investing is often a long-term strategy, as growth companies typically take time to reach their full potential. 3. Inflation protection. Investing in companies with strong growth potential can help protect against inflation, as their earnings are expected to grow along with the overall economy. 4. Diversification. Growth stocks can add diversity to a portfolio, as they often come from different industries and sectors than more traditional value stocks. 5. Focus on quality. Growth investing typically involves investing in companies with strong financials, good management, and a competitive advantage. However, growth investing can also come with higher risk, as growth companies may not perform as expected and their stock prices can be highly volatile. It is important to carefully consider the risks and benefits of growth investing and to diversify one's portfolio across a variety of investment types. Importance of diversification. Diversification is an investment strategy that involves spreading your investments across a variety of assets, industries, and geographies. The importance of diversification lies in its ability to reduce risk and increase stability in an investment portfolio. Some of the key benefits of diversification include 1. Risk reduction. By investing in a diverse range of assets, you can reduce the overall risk of your portfolio, as a decline in one investment may be offset by gains in others. 2. Improved returns. A well-diversified portfolio has the potential to generate higher returns over the long term, as it provides exposure to a wider range of investment opportunities. 3. Market uncertainty protection. Diversification helps to mitigate the impact of market uncertainties, such as recessions or market corrections, by spreading your investments across multiple sectors and asset classes. 4. Improved portfolio stability. A diversified portfolio is less susceptible to large swings in value and is more likely to experience steady, consistent growth over time. 5. Reduction of concentration risk. Diversification helps to reduce the risk of holding too much of a single investment, which can be a significant risk if that investment performs poorly. Overall, diversification is a critical aspect of effective investment strategy, as it helps to minimize risk and increase the stability and long-term potential of an investment portfolio.